Good afternoon. Thanks for joining us for the employee benefits update. This is Karen Sanchez. I'm one of the partners here with Sikich. I appreciate you joining us for this hour to go through a number of different topics on different things that have been going on in the benefits industry. The recent years have had so many changes, so we wanted to just touch base with you on a few things that have come up in the last year or so and have you prepare for the coming year on some of those items. I have Brent DeMay with me as well. He's another one of the partners in our employee benefits audit group. Just to kind of give you an overview of what we wanted to cover this afternoon, Brent is going to go through some of the recent guidelines that have come out from the Department of Labor's audit quality study. The Department of Labor does govern the quality really of the audits that firms such as Sikich perform, and they have announced some of their findings as well as some of their concerns over issues that are arising during those audits. And that kind of leads us into what the Department of Labor has recommended are considerations when you engage certain benefit plan audit firms to do your audit. Brent's also going to cover, this year we've actually had some simplification, if you can believe it, with regard to some of the financial reporting requirements that go into the audit reports for those of you who are required to be audited. So they kind of refer to that as the simplification standard. Very much appreciated by us auditors at least, and so hopefully plan sponsors will find some of those a bit refreshing as well. I'm going to go through a benefits regulatory update, some things on both the retirement and the welfare side. I'll also cover some things that have been happening in the fiduciary responsibility area, and then Brent's going to cover some of the common errors that we see in benefit plans through our audits, and the IRS finds as well, to kind of give you a sort of a overview of some of the things that you may want to look at in your plan as well. So hopefully we can get through this in an hour. We really try to just highlight and touch on a number of these. Really any one of them could be its own hour or really day-long topic as well. So I'll let Brent start with the Department of Labor Audit Quality Study.
All right, thank you, Karen. Diving right in, let's get into our Department of Labor Benefit Plan Audit Quality Study session. In general, the Department of Labor sampled about 400 benefit plan audits across 232 firms and separated those audit firms into 6 separate strata. And these strata were based on the size of the firm's benefit plan audit practice. So not necessarily the size of the firm itself, specifically the size of the plan audit practice, and found that overall about 40% of audits had what the Department of Labor considered in their view or their judgment as major deficiencies. They also noted that the audit quality that they viewed correlated directly with the size of the firm's benefit plan audit practice. So I've included a table. This table is directly from the Department of Labor's quality study. It indicates what those strata were, what they deemed the deficiency rates were by strata. They also disclosed the significant areas where they found the most deficiencies. So this slide lists out areas such as planning and supervision, investments, contributions, benefit payments, participant data, party and interest, compliance reporting, and internal controls. So noticeably, many of these areas are those areas that are relatively unique to the benefit plan audit area. In the following slides, I've gone through and listed out what the Department of Labor found to be the most prevalent or significant areas where they found issues. So going through these briefly, the planning and supervision areas, no or insufficient review of plan documents, or the proper audit communications not being made. So those board letters, the communications on internal control deficiencies, lack of evidence of audit planning or documenting fraud risks, or analytics not being documented in the auditor's work papers. In the investments area, one of the most prevalent finding was just in general, no work performed. The Department of Labor's standard is that if the work is not documented, it wasn't done. So they're not seeing proper documentation of work being performed on several of the areas we'll talk about today, actually. Investments, I mean, some of the areas outside of no work performed include not testing proper year-end values, transactions during the year, investment income, and for those plans that are audited as a limited scope audit, which is the majority of the plan audits out there, they found some instances where the proper certification wasn't obtained, and that's very important for limited scope audits to support that level of audit and that type of audit opinion.
And I guess just to add to the kind of the importance of this area is that if the Department of Labor deems an audit substandard, they can reject the audit report. And if they reject the audit report, that means the plan sponsor needs to get a new audit to replace that one, or they're deemed to not have satisfied that audit requirement. And the Department of Labor can assess penalties up to $50,000 per year for not having submitted a qualifying audit report. So these are all things that do become relevant for plan sponsors, and that you want to make sure that your audit firm is doing what they're saying they're doing to meet the Department of Labor's requirements, as well as you want to make sure that obviously if you're paying that money to have the audit done, that if there are issues out there, they're being raised as a part of the audit. So sorry, go ahead, Brett.
Right, so that's a great point. A substandard audit really could lead to a significant, a significant amount of additional time and expense on the behalf of the plan administrator or the plan sponsor. So the next area, contributions, is pretty specific to benefit plans and how they're recorded and reported in the financial statements of a benefit plan. The most prevalent area, again, is no work performed. But the Department of Labor is still seeing a lot of issues with timeliness of participant contributions. That's an area they've really been emphasizing. They really look for that in plans, and that's an area they continue to see a lot of issues, a lot of participant contributions not being remitted timely. They also find a lot of issues with the plans operating in accordance with their definition of compensation. So really looking at that plan document and making sure the definition of compensation being used by the plan is accurate. As well as some firms not agreeing or reconciling contribution across the different types of records. So reconciling payroll to trust records as well. Another area, benefit payments. Again, some concerns with the work performed, the recalculation, so the clerical accuracy, benefit payments being recorded in work papers, the work regarding the validity of claims in the event of, or in the case of health and welfare plans. And one of the big items that the Department of Labor emphasizes as well is the inappropriate reliance on SOC 1 reports. So the Department of Labor has indicated that auditors may reduce their testing based on a SOC 1 report, but they are not able to eliminate their testing. So that's something that audit firms need to be aware of, and the Department of Labor is looking at that as well. Participant data, another area that's very specific to benefit plans. Issues include no work performed, failure to appropriately test investment elections and payroll data. Another area where the Department of Labor identified definition of compensation being an issue. Party and interest, not having, the Department of Labor cited not having adequate documentation of the work paper files, not having an adequate listing of the related parties or parties and interests that are involved in the plan as being some of the main issues there. And then when it comes to compliance with the auditing standards and accounting principles, and also specifically the Department of Labor's rules and regulations, which are specific to benefit plan audits, this is the financial reporting that the Department of Labor is actually viewing and is being attached to the Form 5500s. They're identifying inadequate footnote disclosures, the fair value measurements disclosure not being appropriate, delinquent employee contributions not being reported accurately is a major issue they've identified. as well as those required supplemental schedules that are part of the Department of Labor's rules and regulations not being prepared properly or attached to the financial statements as they're intended to be.
And keep in mind that when you file the 5500, when you submit it electronically with the Department of Labor, it's on their website and it's available for all public information. So, you know, anybody can download that information and see when footnotes are not listed appropriately. I think in the last week, we've looked at 2 different plans that we were asked to propose on. Neither one had an audit report. One had you can quickly tell at a glance if there's, some issues with some of those
Right.
filings. And if it only takes us a second to see that when the Department of Labor is screening through those submissions, it's fairly easy with the OCR, reading and so forth for them to scan through and identify certain deficiencies that exist in there. So they're trying to use technology more and more to identify those filings that might not be in compliance.
Right. So the final area I wanted to touch on briefly on the audit quality study is regarding internal controls and the failure to really document appropriately the control environment of the plan. And a lot of times that's going to be documented in SOC 1 reports as well as documentation relating to the plan sponsor itself. Benefit plans are also specific or unique in the area that a lot of the control environment for many plans tends to be outsourced. To a trustee, for example, to a payroll processor, for example. The plan auditors are still responsible for obtaining and understanding the controls at those outsourced locations. So this has been, it's quite a lengthy list, and the Department of Labor's audit quality study actually has much longer lists, and we would be happy to provide a copy of the full Department of Labor study if you'd like. Our contact information will be available at the end of the webinar. But it seems like these are the most prevalent issues the Department of Labor identified, and it really outlines the Department of Labor's identification that there are audit firms that are providing these types of audits, so benefit plan audits, that they're really looking to make sure audit firms have the requisite skill and ability to do a quality job for plan sponsors and for the protection of plan participants. The Department of Labor is also reaching out to plan sponsors, so perhaps some of you on our call today have received communications from the Department of Labor just informing you of this audit quality study and the need to perform a quality audit. All right, well, continuing on the topic of audit quality, our next section is engaging a quality benefit plan auditor. So a quality audit in general will make sure or help protect the assets and integrity of your employee benefit plan and ensure that your employee benefit plan is able to meet the objectives it's intended to meet. For example, paying out retirement benefits as intended or being able to fund health claims in the case of a welfare plan. And a quality audit will also help you carry out your legal responsibilities as plan administrators or plan sponsors when it comes to filing a complete and accurate return. Karen mentioned just a few minutes ago about some of the risks of not performing or not attaching a quality audit. Audits that are deemed substandard by the Department of Labor's review could be rejected, as she had mentioned. We've summarized some of the potential risks here, not only just the lost time and resources that the plan sponsor for having to possibly reproduce or repeat an audit or bring an audit up to compliance. There is significant effort and cost in a rejected filing in terms of possible DOL fines. So in the fall of 2015, so pretty recent, the Department of Labor sent out an email to many plan sponsors recommending the plan sponsor consider a series of factors when identifying quality auditors. So I've reproduced those factors here that the Department of Labor had communicated to many plan sponsors, and these include things like making the number of employee benefit plans the audit firm audits on an annual basis, the extent of specific annual training in the benefit plan area specifically, the CPA's license status, whether there's been any prior findings or referrals, and whether that firm is subject to peer review.
Just to give you the Sikich answer on those for those of you who are our clients, so I know we did get some inquiries from from some of our clients actually asking us to respond to a lot of those. So Sikich does about 200 plan audits, and all of our CPAs go through at least the minimum of 8 hours of EB-specific training each year, as well as typically expanded training behind that. Everybody's CPA licenses are up to date, and we've not had any findings or anything else. We do go through the peer review regularly, and that report was issued with no comments as well. So you don't all have to email us unless you'd like to, with regard to those topics. But feel free if you have any inquiries into any of these items further, though.
All right. Now, I actually put together just some statistics from our independent research here, just to kind of illustrate the Department of Labor's point. So there are people on the call today from across the country. However, a majority of our listeners appear to be from that northern Illinois area, where Karen and I are primarily based out of. So I put together some statistics for this kind of market where Karen and I are located, and compared that to some national statistics. Now, this is kind of our independent research. These aren't official statistics that the Department of Labor has published or anybody else has published, but they're really meant to illustrate just the number of audit firms that are performing these types of audits. So if you look at just northern Illinois, there's somewhere in the neighborhood of 3,300 benefit plan audits performed across 400 benefit plans, and out of those are 400 audit firms. Now, out of those 400, only 9 of those firms perform more than 100 plan audits, while 320 of the 400 firms perform 5 or less, with many of those firms performing only 1 or 2 benefit plan audits. So that just illustrates that there are fewer firms in that 100-plus plan audit area that, if you look back at our first session, the Department of Labor deems as kind of having that lower instance of deficiency risk. But there are a lot of firms out there to evaluate. So that's where the Department of Labor is really looking for plan sponsors to actively screen their plan auditors. Now, this isn't to say that there aren't firms of all sizes performing quality audits. There certainly are firms of all sizes that are capable of performing high-quality audits. This study and these statistics really just illustrate that plan sponsors really need to be on notice to ensure they're engaging an experienced quality benefit plan auditor. The next session, moving away from audit quality and Department of Labor releases, relates to two of the new reporting updates this year. And our summary will be a bit brief. This is another topic that could really be a whole webinar in itself. So we'll start with the first standard. It's ASU 2015-12 is what we'll start with. And this standard is actually effective for plan years after December 31st, 2015. So this year, most of our calendar year plan audits now are technically not required to implement these standards. However, early adoption is permitted, and industry-wide, my observation is that most plans are adopting early. So that's kind of our observation. Now, this standard addresses 3 separate areas: fully benefit responsive investment contracts, which they call FBRICs, investments and fair value measurements disclosures, so that fair value disclosure that's a big part of our overall disclosures, as well as providing a measurement date practical expedient, which we won't go into detail today because it's very rarely applicable that applies. That really applies to plans that have a year end that's in the middle of the month. So briefly, so the first section regarding FBRICs, FBRICs are no longer required to be reported at fair value. These are now reported at contract value. So in the past, they would be reported at fair value. Then you might have that adjustment line item on your statement of net assets and bring those contracts back down to contract value. So you'll not have that adjustment anymore either. And since these FBRICs are now presented at contract value, the disclosures, so the fair value measurements disclosure, will not need to include the FBRICs because they're not reported at fair value. The disclosures also that are relating to FBRICs that are no longer required under the simplification standard include the nature of each type of FBRIC, the events or the probability of those events that limit the ability to transact at contract value and the terms of terminating or settling the FIB breaks. However, each type of FIB break needs to be disclosed in the footnotes. For example, if there's a traditional insurance contract, a synthetic GIC, the footnote disclosures need to identify that which types of FIB breaks are held by the plan. Also relating to the fair value measurements disclosure, we are now able to, in the table where we level the investments between level 1, 2, and 3, those investments can be reported as a general type, so mutual funds or common stock, where in the past couple of years we had to break it out by risk type. So a mutual fund would be further broken up between something like small cap value, large cap growth. We're now able to just have that table be reported by general type. And if you have self-directed brokerage accounts, those are now presented as a single line item in the aggregate versus breaking out the underlying holdings. And if the plan has an interest in an investment that reports a net asset value, so that could be your collective trust or pooled separate accounts, you're no longer required to disclose the investment strategy as long as those investments are filed as a direct filing entity, which you would find on your plan's Schedule D. The disclosure regarding the investments that represent 5% or more of net assets and the disclosure relating to the breakout of net appreciation by type of investment are also no longer required.
So Brent, if you remove those different risk categories for 2015, will they also be changing those for 2014, or will the 2014?
So yes, the presentation is retroactive or retrospective. So you would apply these standards for both years.
Thank you.
And then 2015-07 is also early adoption is also permitted this year. It's also for most of our December calendar year plans, it wouldn't be required. Again, I see most plans early adopting the standard, and this really just is how those investments at net asset value, so your collective trust, your pooled separate accounts, this is really just how those are presented in the fair value measurements disclosure. So these types of investments are no longer leveled, so you're not determining if they're level 1, 2, or 3. Underneath that table, they're being presented as a reconciling item, so that so the fair value table can then reconcile to the fair value on the statement of net assets. So this has just been a very quick general overview of the major areas that these two standards will have impact, and you may see changes this year during your financial reporting and possibly your audits. There certainly there may be some more specific questions or items or circumstances that might come up, which you can feel free to reach out to us with those questions come up. But we just wanted to have a brief conversation and make sure our audience was aware of these couple standards. So now I'll turn it over to Karen on her session regarding benefits regulatory update.
Thanks, Brent. So for those of you who have been following any of the updates in the benefits world, I think we've had more updates in the last year than I can remember in most of my career, with the addition of the Affordable Care Act entering into the picture on top of all the other legislation that we've had. So I'm going to just try to give you a quick update on some of these to make sure you're aware of some of the issues that are out there, and we can certainly discuss offline in further detail. So hopefully all of you are now familiar with the Affordable Care Act reporting requirements. For 2015, and actually prior to that, individuals must have health insurance coverage. There's certain exceptions to that, obviously. In the past, the IRS just trusted what you reported on your return. For 2015, the IRS needs supporting documentation from the insurer to cross-reference that, as well as the employer mandate penalties are implemented to ensure the employers are meeting those requirements. And then so thus all the new reporting requirements that you may have heard about coming out. So applicable large employers, those that have at least 50 FTEs, which is a combination of your full-time employees plus a fractional component of your part-time employees. If you have at least those 50 FTEs in 2014, you have a filing obligation for 2015. There's a variety of different rules, and I know we've done different webinars and topics on those things, but wanted to just give a quick overview on that. So originally for 2015, that reporting requirement was due the same as what a W-2 would, for example. So by January 31st, originally, those forms should have been provided to the employees, and by the end of February, all the forms should have been to the employers, and we should all be done with this whole process as of now. But in typical IRS fashion, the holiday gift that came out, right after Christmas was that they released Notice IRS 2016-4 extending those requirement filing deadlines. So the forms are now due to the employees the end of March. I think most of our clients have finished it or are in the process of finishing them and in working out those final details. The IRS filing piece of that then is due May 31st, or if you're electronically filing, June 30th. So the IRS did give us some extra time in order to meet these challenging requirements this year. In addition, at Christmas time, they came out and also issued IRS Notice 2015-87 with a number of clarifications to all this. So everybody was working really hard at getting all this data together, and then the IRS came out and gave some more guidance and changes on everything that everybody had been doing. Just to highlight a couple of those things, anybody who's worked through this area knows that there's a lot of questions that have come out, and so some of this was welcome clarification and other ones brought up other issues. The biggest area, just to make you aware of, is that if you have any other types of payments, if you're paying the insurance premiums, obviously subsidizing a portion of the policies, that's one way of providing health care. Certain times you may be providing additional payments into a cafeteria plan or a health reimbursement arrangement or a health savings account or something along those in that nature. And they clarified how those types of things impact things like your affordability standards and what you should be reporting in terms of that line relative to the employee's lowest cost of self-only coverage. So if you're providing any other of those types of payments outside just strictly providing the premiums, I think it's an area just to take a look at and see if it modified any of your reporting requirements. The IRS also came out with guidance on areas such as opt-out payments. If somebody doesn't take your coverage and you give them $100, that opt-out payment could impact how you're, again, reporting your affordability premiums as well as your calculations. They talked about things like employer flex payments, grace period for HRA plans. And they also reminded us that certain standards such as the affordability threshold is actually indexed. We all kind of generically started referring to affordability standards as you have to provide premiums that are not more than 9.5% of income. Well, that's actually indexed. So the actual number you need to use for your affordability standards is not really 9.5%, but it's actually 9.56% for 2015 and 9.66% for 2016. So for those of you who are sort of borderline on whether or not you met the affordability, you may want to take a look at whether or not you meet it under the indexed amounts. Similar to that, the IRS also reminded us that the penalties that we sort of generically referred to as the $2,000 penalty should you fail to offer minimum essential coverage is actually $2,080 for 2015 with the indexing, and as well the $3,000 should you not offer affordable coverage is actually $3,120 as well. So that was a nice holiday surprise that might be slightly higher amounts. And then also they gave some more clarification on how hours of determining information is calculated. They also, on the Cadillac tax, while it's not yet in effect, they delayed it further. Now it's not effective until 2020. They also indicated that if you are subject to the Cadillac tax, it will become a business deductible expense. So I guess that'll offset the amount a little bit. As a reminder, the Cadillac tax is calculated based on 40% of it's a 40% tax on the value of health insurance in excess of these thresholds of $10,200 for individual coverage and $27,500 for family coverage. And of course, those amounts will be indexed as well. I think that most of our clients are working with brokers that have done these projections, and they're creating strategies to hopefully avoid this area. Some of the things to make sure that those calculations are taken into account are things like other employer payments, such as payments to FSAs, flexible spending accounts, or health savings accounts. Seems like the IRS right now is leaning towards really anything that's pre-tax, including employee amounts to those 125 plans. For normal flexible spending amounts up to that $2,500 per person, that those could potentially enter into your tax calculation. So I think most of the welfare plan community is monitoring this to see what's going into that. But as you take a look at modifying things, you want to keep in mind that these things could affect your potentially being subject to the Cadillac tax provisions. The Form 5500 is the information return that retirement plans and welfare plans are required to file. We submit with the Department of Labor electronically, and then they share that information with the IRS. For defined benefit plans, the PBGC also shares information, so it's really shared amongst 3 regulatory agencies. Sometimes the IRS and the Department of Labor don't really talk to each other in advance of issuing rules, and there's been a couple examples of those of that issue. So the IRS in 2015, when you see your forms for 2015, you'll notice that there's a number of new questions, whether you're a small filer or you're a large filer. It's just located in different places. If you're a large filer, Schedule R has a new part to it. If you're a small filer, there's a new Part 9 on the form. So they came out and issued all these different questions asking you things like, what's the last time you amended your plan? Have you filed everything on time? What's your IRS determination letter date? What method of coverage did you use for ADP? What method of testing did you use for coverage? Trying to probe a little bit deeper to determine non-compliance in certain areas, and obviously to figure out areas that they may want to select plans for audit. There was a lot of pushback from the retirement plan provider community on how burdensome it would be to provide this information because it's not currently built into the systems, and it's going to be manual entry for hundreds of thousands of plans that are out there. In response to that, the IRS said, well, it's optional. So not sure who wants to provide information they don't have to provide when it's optional, that can just strictly be used to raise other issues with the IRS. In fact, last week the IRS now came out and said, well, actually don't answer these questions at all. They're not even optional, but don't fill them out. So we seem to have a bit of evolution, and now we have questions on the form that are just intended to be blank. The Department of Labor also announced that they're going to sort of overhaul the 5500, and there's going to be sweeping changes coming out. They've not yet issued what those are going to be. They've just announced there will be changes coming. So we'll see what they come out with and what they would like the form to look like going forward. Originally, the IRS extended the deadline for 5500s to November 15th rather than October 15th in connection with extensions and changing deadlines of a number of other tax returns. However, the Department of Labor didn't like that, and so they agreed to repeal that change, and so now that all will remain with the same filing deadline going forward. Welfare plans, historically have not received a lot of attention in terms of investigations unless complaints arise. And with the advent of things happening on Affordable Care Act and so forth, they are receiving more attention now. And the Department of Labor and IRS are both shifting some of their resources from the retirement plan group over to the health and welfare plan group. So it's kind of an ideal time to kind of take a look at what you're doing on your welfare plans and make sure that you're meeting all the conditions you need to. So when I say welfare, it's generically referred to or includes really a number of different provisions such as your health, your life, dental, disability, life, accidental, and a whole number of things. It's kind of a very broad category to use for welfare. And with everything with the IRS regulations, there are a number of exclusions to that. What I like to tell clients is that pull out the list of all the benefits that you offer to your employees, your handbook, or if you just have a benefits offering, pull that out, determine what's subject to ERISA and what's not, and then from there, the next step would be, do you have a plan document in place for each of those benefits? You'll likely have some sort of a booklet provided by any kind of fully insured providers, although sometimes those don't have all the requirements in them that ERISA mandates need to be in your plan document, and or they may not have all the disclosures that need to be in what's referred to as the summary plan description that goes to the participants. That plan document will dictate whether or not what is included in the provisions of that plan and may go into a 5500 filing. We get the questions all the time about, well, how many 5500s do I have to file? I have a health plan through, ABC vendor, and I have a life insurance plan through XYZ vendor. Do I file one 5500 or not? And we'll say, well, what does your plan document say? And then they say, well, I don't have one. There's a concept out there called a wrap document that what it does is it ties together those 2 or however many different plans the employer may have, and now calls it the ABC welfare plan, which provides health benefit and it provides a life benefit under these policies. And that document makes it very clear then that they have one plan which provides these multiple benefits, and then that one plan then is what you would look to determine whether or not you have a 5500 filing requirement. And that filing requirement exists if you have more than 100 participants on the plan as of the first day of the plan year. We find a lot of these forms not being filed or being filed on a combined basis when they shouldn't be, or a benefit gets missed. There's often not a coordination between who's filing the forms and who's issuing the policies, and not necessarily making sure that you kind of take an inventory of all the benefits you offer out there. So particularly when employers just go over 100 employees, there's no magic notice that comes in the mail one day that says you have to file, so sometimes it gets overlooked. There are a number of voluntary programs with some, there's fees associated with it, but they're much less than if the IRS or Department of Labor send inquiries. They're also matching it up to your retirement plans and saying, hey, you've got 100 people on your retirement plan, I don't see a welfare plan. So it's maybe something to take a look at if you haven't sort of reviewed this area recently. On the retirement plan side, there are plan document restatement requirements. Most of you have probably completed these by now. They're all due the end of April of this year for prototype plans. So if you haven't heard from your vendor yet with respect to that, you may want to follow up and make sure you're on the list. And going forward, the IRS is not going to issue determination letters for updates to individually designed plans as well. And there's more. Then the IRS came out this year with some more 401k changes. Safe harbor plans can now make mid-year plan amendments, which at least to us drafting documents is kind of exciting that there's some more flexibility with those plans. However, when they gave us this benefit back, they took away the ability to offer contribution allocations to be done on each participant being in their own rate group. So if you make different contributions to different individuals, in the past the IRS gave us that flexibility, now they want to take it back away. You can still offer different contributions to divisions of employees, categories of employees, things like that, but when it comes down to each individual having their own rate group, the IRS is now saying they don't like that option. So it just might make it more challenging to pass your discrimination testing. So it might be an area to look at. We may win again, but the IRS didn't like it, now they allowed it, and it back away again. So we'll see where that ends up. Real quickly, I'll touch on some of the fiduciary responsibility area. If you followed any of the benefits items in the news, you hear the term fiduciary regularly. Plan participants can now sue employers for failure to properly oversee, generally it's investments is what they're focused on, because participants see that they don't have sufficient funds for retirement, they're looking to blame somebody, and they look to see, did the employer do certain things? Did they offer good investment funds? Were the fees reasonable? And so you as a plan fiduciary want to make sure that you're protected, as well as obviously doing things that are in the best interest for your participants so you don't get into that situation. The Department of Labor also monitors this area, and regularly, if you follow this area, you see a variety of lawsuits where the Department of Labor is suing different employers for excessive fees and things of that nature. So it is an area to make sure that you're doing some due diligence in and satisfying some of these rules. So retirement plan fiduciary is somebody that's responsible for managing the retirement plan assets on behalf of others and has a special relationship of trust, confidence, and legal responsibility. The normal roles, I mean, somebody at the plan sponsor is always going to be a fiduciary. Whoever is either named or by actions is satisfying a fiduciary role, so the plan administrator. folks sitting on the investment committee. Sometimes those service providers that are providing advice for a fee are going to be a fiduciary. Some providers will not act as a fiduciary, and that's something that in your agreement with them, they'll indicate whether or not they act as a fiduciary. Fiduciary has to always act in the best interest of the participants, can't be self-serving, so that there really is a higher level standard that they are held to, rather than just being a broker who sold a product to you that doesn't have any ongoing responsibility for that sale, if you will. So the fiduciaries have to act in the best interest of the participants. They have to carry out their duties prudently. They have to follow the plan documents. They must diversify. And one of the biggest topics is making sure that fees are reasonable, and making sure that first you have to understand what your fees are, and then you can document what methodology you went through to ensure that they were reasonable. There is some regulatory oversight, obviously, over all these plans. Just wanted to emphasize that the IRS is more concerned about, did you follow this rule, and generating revenue for non-compliance, versus the Department of Labor's real mission is to protect participant rights. Is anybody being harmed? And so when you look at the nature of the audits and investigations they do, there is a bit of a different focus, although they do ask for different things throughout that process. So plan sponsors, what's your kind of to-do list with regard to this area? I mean, first thing you have to do is understand what you're supposed to do as a fiduciary. Second is to establish a formal governance process, and this is some of the things that we talk to clients about as a part of the audits of what have you done. Do you have a committee? Does that committee meet regularly? Do they document what has been done? And documenting your investment process in an investment policy statement. It's kind of your rule book of, this is what I say I'm going to do, and then you document your compliance with that. When are you going to replace a fund that's in your investment lineup? Is it if they're out of the range for 1 quarter or 2 quarters? But setting out that roadmap, and then you're not being held to the standard of trying to time the market, and if the market doesn't perform, it's not a deficiency that you as the plan sponsor had. You followed your process throughout that time. Documenting things is ideal. It's going to be one of the first things the Department of Labor asks for is, where's your minutes, where's your documents, what did you do? Demonstrate what you did to satisfy that you monitored your investments and you know what your fees are going to be. And it's particularly important when you have turnover in those positions. If you're the new person sitting in that chair and you've ever had that Department of Labor auditor or Department of Labor investigation or IRS audit, and you're the one that has to provide information for a period of time when you weren't working there, you'll understand sort of the importance of why you wish others had documented what had happened. And so we always ask for that as a part of our audits, to get an understanding or give clients the opportunity to memorialize what may have happened each year as we go through. You want to conduct a regular review of the plan's investments. Regular means different things to different people. Some people say it needs to be quarterly, sometimes semi-annually. You need to have a methodology and stick with that in order to make sure that you're routinely looking at things that might change with plan investments. There's companies merging and acquiring companies all the time. Money managers are changing from here to there, and it's really important to know when a major a key person at an organization maybe is no longer there anymore. Is that fund still a viable investment option for the plan, etc. Educating participants to make sure they make informed decisions. The more folks that are able to, the more information that you arm them with, the more defense you have that you provided them this information. They made the decisions in terms of the assets that they chose to select. If they selected a really aggressive portfolio close to their retirement and the market tanks, you gave them all the information to decide what type of an investor they were, whether they're not an aggressive investor or moderate, etc. And then monitoring fees, as I said before, is probably the biggest area, and they don't make it easy. With fees, they can be charged in a whole number of different ways. Sometimes you see the fees and they're direct, but most often there's going to be some indirect fees. There's fees within the mutual fund expense ratios. There could be fees built into a wrapped annuity contract with your record keeper, things like that. So the first thing you have to do is kind of come up with that laundry list of who are all your service providers to the plan. Get copies of the contracts, because they're required to disclose to you in writing what their compensation is, how it's calculated. And then you need to determine what the fees are in the plan, which is easier said than done. And then you have to find a way to determine if those are reasonable in light of the services provided. And so that's where this fee benchmarking concept comes into play, that you want to make sure that at least periodically, probably no more than every 3 years, you've done really a full fee benchmarking study. Things are changing in the 401k market in terms of costs. In general, they've been trending down as technology improves. Your fees per person hopefully are declining, and as the plan assets grow in your trust, in general, that your percentage per person hopefully is going down, whereas your dollar amount may be going up, and that's where regular reviewing these become so critical, to make sure that what may have been reasonable and appropriate 3 years ago is still in light of where your plan's at today. I mentioned before, some providers in the investment area act as a fiduciary, others do not, and they will have explained that to you in the service agreement that they were required to give you. The Department of Labor had issued standards on 408b2 regulations a number of years ago, and required that one of your fiduciary responsibilities is to receive that notice from them. Not only receive it, but obviously read it, understand it, to make sure that you can use that as a tool to truly understand and monitor those fees. So the Department of Labor has had a number of different rules that they call kind of this fiduciary rule, and there's been proposals out there, modifications and changes and requests for comments, actually for several years. And we really still don't have an answer on this area, but just wanted to make you aware of what the Department of Labor is working on in this regard. Essentially, it would require all consultants providing investment advice to become a fiduciary. And obviously, those that already act as a fiduciary are highly in favor of this, to kind of put everybody on a more competitive playing field. But those that are not acting as a fiduciary do not want this rule to come through. So there's a lot of lobbying back and forth, and you're seeing a lot of changes in the investment provider space preparing for this rule to potentially be implemented going forward. So we'll see what happens with that. Nothing has been officially come out yet on it. We just give you kind of a laundry list of things here to, what you may want to do as a to-do list to take a look at your own processes. There's a lot of checklists out there that could be good resources on, kind of taking inventory if you're doing what you're doing. Hopefully you're working with, an investment advisor that is providing a lot of this and kind of acting as the quarterback, walking you through a lot of this process, because many of them bundle all this into things that they provide. Making sure your committee is getting some fiduciary education, as well. And Sikich has done a number of different fiduciary events to try to help clients get, some of that CPE as well. So we're looking to do something hopefully later this year as well, again, in that regard. So Brent's going to cover some of the common errors that we've seen in benefit plans, to kind of maybe give you a memory jogger, thought of, maybe some of these might be areas that you may want to take a look at in your own plan to make sure that errors don't arise.
All right, well, so our final section, common errors in benefit plans. This is a section we wanted to list out. It's not an exhaustive listing, but list out some of the areas that we find when we're auditing plans. And we also wanted to conclude in this section as well, because it's also a good checklist that you could use as you go back to your daily responsibilities and possibly look for opportunities maybe to improve your processes or something like that. So one area is partial plan terminations. This is something that isn't going to be a regular routine type of thing for most plans. So when there's been a large amount of employees that were involuntarily terminated, we oftentimes find that plans forget to consider, has a partial plan termination occurred here? The area of plan expenses, that's come up a few times in our presentation today, and we see in some areas or in some plans that perhaps the plan expenses weren't following the terms of the service agreement. Perhaps those charges weren't what was agreed on, stuff like that. In terms of discrimination testing, we find that some plans forget to have this testing performed, or perhaps the required tests aren't all performed. And when there are testing failures, we've found that there are plans that forget or fail to address those failures timely. In the areas of employee deferrals, we see plans sometimes miss processing deferral changes. So a participant wants to change maybe from 5% to 7%, and those changes not getting made or not getting made timely. In the area of plans that have the auto escalation clauses, for example, so once a year everybody's deferral rate goes up 1% or 2%. Sometimes that gets missed and that change doesn't get made. Also, not calculating deferrals on the proper types of compensation. That's kind of been a recurring theme throughout our presentation today as well. The definition of compensation that's outlined in your plan document is very important, and we do see some errors in that area in terms of that definition not being followed. And in terms of deferrals on any sort of checks that are not routine, so something outside of the normal payroll run, so bonus checks, manual checks, final vacation payouts, some plans or some companies forget to defer on those. And again, deferrals being deposited late remittances is another recurring theme that we really want to focus on today. The Department of Labor is still really looking at this, and we still also see those issues as well out there. And we've touched on these points a couple times as well already today, but having those late contributions or the delinquent remittances, that is reported on the 5500. There is a line item on the Schedule H for that. So it's important to notice that that does kind of present somewhat of a heightened risk for a Department of Labor audit. And then on the employer match side, we've seen sometimes the match is not getting capped at the maximum IRS compensation limit. So for 2015 and 2016 plan years, that would be $265,000.
Yeah, a lot of times the matches are calculated throughout the payroll systems, which is great to have the technology to do things automatically, but I think sometimes employers forget that you need to go back and check and have controls in place and a review system to make sure that however you programmed into the software is capturing all the different elements that need to occur in those calculations.
All right. Then again, we have another reference when we're actually talking about the compensation is making sure the definition of compensation being used is appropriate based on the plan document. That's something that's mentioned several times because it's just so important, and it's a very prevalent issue that we see in plan administration. Participant loans is an area that we see quite a bit of errors. For example, perhaps a separate loan policy hasn't been formally adopted when the plan document indicated that's a requirement, or when there is a loan policy, things such as the rate of interest or the number of loans that's allowed to be outstanding at any given time perhaps isn't being followed. We've seen some participant loans be issued and then repayment on those loans isn't set up timely. Or we have some loans that we've seen not getting repaid and also not being defaulted based on the terms of the plan. In the area of mergers and spin-offs, we see that there's at times no board resolutions or plan amendments that make it clear what the date of legal transfer of title of those investments are, which may or may not be the same as the physical date of transfer, but the reporting requirements follow the legal date of title transfer to those investments. We also see at times there's no or inadequate blackout notices, or that the transfer hasn't been reconciled from the old trust to the new trust. And that would even apply if there isn't a merger. If you are just, perhaps you're changing service providers, you're going from one custodian to another, it's very important to make sure that you're following the money, you're reconciling both at the trust and the participant level, and at the participant level, making sure that everything maps correctly in terms of source, especially if vesting schedules are being used. From an eligibility standpoint, we see that there's improper exclusion sometimes. So sometimes part-time or temporary leased employees are being excluded from the plan, but they're not marked as excluded in the plan document. We see that there's sometimes late notification of eligibility, so a participant's not being able to enroll as soon as they're eligible. And then the opposite, we see that sometimes there's early entry into the plan, so a participant hasn't technically satisfied the eligibility requirements, but is still being allowed in the plan. And auto-enrollment sometimes is not being implemented timely as well, so participants aren't getting into the plan based on the auto-enrollment provisions. And forfeitures as well. Forfeitures, it's important to review your plan document and have a great understanding of how forfeitures are to be used. Oftentimes they're used to reduce employer contributions or reduce plan expenses, but they could also be used to, or they could be reallocated to participants. So it's important to use forfeitures as indicated by the plan document. And distributions as well is another area that's pretty specific and unique to benefit plans. So some of the things that we see in terms of processing distributions is the required minimum distributions not being made, or vesting calculations not being accurate when recalculating the benefit payments, or hardships or in-service distributions being allowed to be paid out of the plan when the plan document doesn't allow those types of distributions. When a hardship is allowed, we see sometimes plan administrators aren't obtaining the proper documentation or aren't stopping or starting deferrals based on when the hardship was taken. As well as annuity payments. This is mostly relating to defined benefit plans. One area that we see is annuity payments not stopping when a participant dies. So this is certainly not an exhaustive listing, but it concludes our prepared checklist. If there are any specific questions or comments, please let us know. And
we included our contact information for myself and Brent here if you think of any other questions you may have after the session or as we move into, really just, everybody's probably finishing up their compliance testing this time of year. We'll be starting on the 5500 filing and the audit season coming up. So, hopefully this highlighted some of the things that might be new to be dealt with during this upcoming season. And as always, the IRS may change the rules as we go along, or the Department of Labor, so we'll be watching out for any of those potential changes as we move forward. Also on the survey you received, there is a box for comments. If you have any requests for different topics that you'd like to hear more about, either in newsletter format or in a live event or a webinar, we'd appreciate any kind of feedback or comments you may have, because we'd like to obviously design these events with the topics that are of most interest and relevance to you. So thanks everybody for your time today. We appreciate it, and we'll be getting a recorded copy of the webinar and slides off to you guys shortly. So have a great day, everybody.